Usual disclaimer, please pause the video if you have to familiarize yourself. Neither this presentation or anything on my Twitter, Telegram, or any other media mode of communication, including private correspondence, constitute financial advice. This is for entertainment purposes only, as boring as it may seem. So some general remarks about trade management. So it's one of the more psychologically challenging elements of a trade. It's probably one of the last things that developing traders think about, or when you're just starting out, when you're learning all these cool tools for entries and these cool techniques, indicators, actually managing a trade from A to B is not something that really comes to mind until you find yourself in a live environment. You're staring at the chart and wondering what on earth you do now that the position's been opened, right? And there's a spectrum between set and forget and active management. So you see this kind of wisdom parroted a lot that, oh, if you're stressed about your trades, you should set and forget, which I don't entirely agree with. It's certainly not a one-size-fits-all approach. At the same time, you get traders who have fantastic swing trade ideas. You know, they can draw it all, do all the squiggly lines, risk-reward tools, but then when it comes to babysitting the position or just holding it from A to B, they end up losing their shirt. Okay, so that kind of spectrum between those two extremes worth investigating, both in terms of your data, your journal, your own research into how you perform. I think it's also trading style dependent, as mentioned or alluded to earlier. You know, how much set and forget are you going to be able to do if you're scalping a tick chart versus swing trading a weekly chart, right? Quite different. And on a similar theme, timeframes as well. Different timeframes lend themselves better to active or passive, if you will, management. And that is something we'll look at throughout this video as well. Trade management is where good trade ideas go to die. As dramatic as it sounds, I'm sure it's happened to you. It still happens to me, happens to fantastic traders that I know, where trade ideas, which are beautifully laid out, simply do not fully come to fruition, where trade management gets in the way. You either cut too early, move your stop too early. There are a million things, as you'll find out during the course of this video, you can do to mess up an otherwise fantastic trade. So developing a framework for trade management is a big part of bridging the gap between analysis and trading. Now, a recurring theme throughout this entire video, it will get repetitive, but I think this is something that never really goes away, is that it's important as technical traders, or as speculators generally, to trade the chart, not your P&L. I started trading really well and saw big improvements in my own performance when I focused on the process of trading well rather than the P&L or the results per se. If you trade well and focus on procedural propriety to some extent, the results tend to align. Okay? And the market doesn't know, doesn't care where you entered or your exit or your risk reward or any of those things. It's agnostic as to your particular circumstances. If you're a technical trader, which you probably are watching this video, we're here to trade the technicals, and trade management is no exception to that. This video complements the lesson on entry triggers. It also complements the lesson on risk management and a whole lot of other lessons, so I hope you're not watching this first. If you are, you're committing a mistake. Please go back and watch the videos in order. That's for your benefit. So all my content is of limited use in the absence of screen time, but trade management is especially so. I really think that even if you're trading, rather than trading a paper account for years and years, I think it's a meaningful difference to even get, 10, 15, 50 pounds, whatever it may be, an amount you can really lose, and practice managing that in a real environment. I mean, a non-trivial amount that you can afford to lose would be ideal, but I think any live management experience is better than none, even if it's a small amount. So screen time is really your friend when it comes to these things, and that's really where you'll develop and refine your system. So let's get into it. The definition and context, quite simple definition. Trade management, a set of decisions made between opening a position and fully closing it, right? That whole time space. So in terms of scope, this video does not explicitly address the list you see there. There's kind of more advanced strategies, compounding, pyramiding, laddering. We don't talk about automated strategies here because we're all line box drawers, right? Technical traders. When, how, whether to scale in and out of positions. Again, position allocation to some extent. That's more an entry triggers type of video, so that's not covered here. And I'm going to try to keep this reasonably short, so can't go over everything, unfortunately. And as you can already probably tell, it's a hard video to make because management is so closely linked to one's entry. and how one system operates. Generally, it's quite hard to foretell and foresee all the possible variables. It's impossible, actually. So I'm going to try to be as broad as possible to encompass as many different trading systems as I can, and so we all get takeaway points that you can apply no matter how you trade. However, manual traders with a price chart focus and a system allowing for some degree of discretion will benefit most from this video. And I think if I have the privilege of having you as my audience and you've learned something from this channel, or your foundations started here, whatever the extent of your involvement, there's a good chance that you'll learn something here, or it will in some way be applicable. Now, the aim, as I said, hard video to make. What am I actually going for? This isn't the type of video, as you'll know from this series, that this is how I do this, copy me and you'll make money. That's not what we're talking about here. I'm trying to provide a framework for thinking about trade management which spurs independent research and addresses common errors. So this is just to get you thinking along the right lines, and if I've done even a half-decent job, you go and experiment and figure stuff out for yourself, just like I did. So as per the first bullet point in the outline, what do I mean by an evidence-based approach? I'm not really talking about the scientific method here, but I mean two things by that when it comes to trade management. The first is, before even getting into the whole discipline, you need to investigate whether you would benefit from actively managing your trades. So if you keep any sort of trading journal, that's a fairly straightforward process, and indeed you probably know the answer to that. If that doesn't make any sense to you, just on a surface level, if you actively manage trades, is it to your benefit? I know a lot of journaling software can actually give you data and simulate trades and outcomes if you hadn't managed them over a certain time period. And as it says on the slide, what would returns be over X trades if left to original entry target stop? At the same time, if you're not actively managing your trades, could you benefit from doing so? Does your system offer you early exit signals or take profit signals that would be to your benefit that you're choosing not to ignore or aren't part of your system because you play on the set and forget side of things? So that's the first thing, what I mean by evidence-based approach. How does or will trade management, or specifically does in its current state, trade management affect your trading? Is it to your benefit? Is it to your detriment? Where do you lie on that spectrum between set and forget versus a more interventionist model? Okay. Now the second meaning, and the one that's going to be relevant for most of this video, is the evidence sort of for your position. So once the trade is opened, reassessing the chart and the technicals to see how you should manage the trade. And so the question, as I've articulated here, are developments in price since my entry aligned with my expectations for this trade idea? So is the chart doing what I expect it to do if I'm right, essentially? Now that sounds very obtuse when said in a vacuum, but as you can see, I've added some bullet points and some examples there. Is price reacting as expected to my technical structure or its break? Is price moving in the expected direction within a reasonable time period? Is price breaking support resistance or making new lows highs, etc., etc.? So as it says at the bottom, just a few examples, but the idea is to exercise your discretion to always be reassessing whether the evidence, which for us as technical traders is the price action, supports your position or goes against it. So from a trade management point of view, if price is developing positively, so in the direction of your trade position and in line with your expectations, then that's fantastic, we manage accordingly. If it isn't, we also manage accordingly, as will be explained in the coming section. So that's kind of an important thing to bear in mind. Evidence-based approach, we're using our discretion to always reevaluate, does this position still make sense? Is the argument for being bullish or bearish just as clear, less clear, even more clear than it was when the trade was first opened? How are things developing in contrast to our expectation for this trade? And the obvious logical implication is that if we have a certain expectation for price and there is no alignment, and indeed you're getting conflicting evidence for your position, we're going to look to close that out before a full-size loss. Okay, so it's not like we opened a position, we're assessing all this evidence, everything is screaming that your position is wrong, and we just sit there saying, well, I've got a stop loss, that's going to be okay. That's not what we're going for here, and that's not the kind of trade management that I think most manual discretionary traders will benefit from. Okay, so that's what I mean by an evidence-based approach. Probably the most common topic when it comes to trade management is the topic of timeframes. And for those of you who are worried already, we will look at some charts. I think 3 trade examples once we go over the slides and kind of bring it all together. Okay, but back to timeframes for now. This section addresses the topic of what timeframes to employ when managing trades, right? Now, in terms of the model used, I'm just going to go with candle closes. I think it's very common, even non-technical traders, weekly close and daily close and all that type of stuff, whether a level's been broken based on candle close, pretty orthodox stuff. So we're going to roll with that. Not saying it's mandatory, but it just makes teaching this easier. Okay, so with timeframes, and I strongly recommend you watch the video on timeframes again before this video, because much of this section won't make too much sense unless you've seen that. But the competing considerations in timeframe management is essentially that if the timeframe is too high, you may miss out on management opportunities. If the timeframe is too low, you'll overmanage and fake yourself out, and excessive management is the risk, right? And you'll see that a lot. Someone enters as a swing position on the daily or weekly time frame, which could take weeks to unveil or materialize, and they're out of the trade on the next hourly candle because it looked scary, right? That's the kind of opposite risk. How do we get about that, or how do we balance these competing considerations? Well, the management time frame is to some extent at least contingent on the time frame of the trade itself. So in a broad sense, intraday trades will require intraday management, so we can actually do something about the position before it moves too far north or south, right? And then higher time frames obviously will be suited for higher time frame management. Sounds fantastic, but what does that actually mean? Here's my own practical tip that I use. Feel free to adopt this, play around with it. It's not some law of nature, as it says below. But for a weekly setup, managing on the entry time frame, so the weekly time frame and a time frame below, so the daily, that's a good starting point for your studies. Similarly, for the daily time frame, managing on the entry time frame, the daily, and then maybe one intraday time frame lower, like the 12-hour, 6-hour, even 4-hour in this example is fine. And then for our intraday trading, again, 4-hour chart, hourly chart, using those same time frames or a smaller intraday time frame, 30-minute chart, 15-minute chart, I really think is a nice foundation or starting point to be along the right lines. Okay, and as it says here, play around with it, experiment, but it's a solid foundation. For me personally, I kind of run a hybrid system, so I'll be trading high time frame levels from the daily and weekly, but a lot of my entries and management will be on the hourly time frame. And I've found if I'm trading high time frame areas where price is going to naturally spend more time, the hourly time frame actually gives me plenty of time and evidence to react and reassess and do all of the stuff that we talked about in this section. Okay, it gives me a fantastic opportunity to track these developments in price and get in and get out before the daily impulse plays out, much of the time anyway. Okay, so that's the framework there. Another part of the framework is managing both sides of a trade. This is really important, probably one of the more neglected parts of trade management. And what I mean by both sides of a trade is that managing trades that are at a loss, so before they hit your stop loss order, as well as those that are in profit, so prior to take profit order. It's so common to see traders rush to manage a trade and move their stop and lock in profit and take off some size and do whatever else. As soon as a trade goes onside, they become the most interventionist people in the world. But yet if the trade goes against them, they take some heat, they sort of pretend it's not happening and they don't see it, and, oh, well, I've got a stop loss, that's what it's there for, it's none of my business. Which is unreasonable, in my view, or at least somewhat contradictory. If you can exercise your discretion ahead of a take profit order, why doesn't it work the other way around? And of course the answer is that it does, it's just most people choose to ignore that. To their own detriment, I believe. Because consistently reducing 1-hour losers to less than a full-size stop out will make a meaningful difference to your equity curve. And it will make you a better trade manager. So you'll see a lot of newer traders when you look at their trading journals, or if they're posting results, you'll see, plus 2R, plus 1R, plus 3R, and then it's like a streak of -1, -1, -1, -1. But then you'll also see plus 0.8R and plus 0.5R. So they'll be managing the winning side of the trades, but then erasing more progress than they have to by just taking the losers on the chin and doing nothing about them. And I'd encourage you as a trade manager to consider both sides of the equation. So some examples. of that, or instances where trade management could come into the equation. So specifically the losing side of things. So before price hits your stop, you can see 3 examples there. Let's say you sold a level of resistance, price has flipped it and is using it as support. At that point, the probability that your trade is correct has reduced significantly, and you can jump out ahead of your full stop loss, and then you can always get back in if that level is once again reclaimed as resistance, right? Or maybe you faded an impulsive move into intro structure. That should not say intro structure, my apologies. Into structure, there we go. With sellers nowhere to be seen, right? Again, price not aligning with our expectations. Or another example, very weak reaction at support, followed by closes through it. If you're seeing that type of price action as a buyer, there's no reason for you to, in every single instance, wait for your manual stop loss to be hit, because as that price action is developing, the probability of your trade being correct is decreasing, right? So don't surrender to fate. You're not a Soviet grandmother. Those of you who are familiar with that culture in many regards will know that they use the dismissive "no это судьба." You know, it's just fate. Don't be like that. You know, we can do better. So let's look at a chart example of some of these things. I actually remember from watching price action at a weekly level. So I'm just going to quickly delineate. We've got this consolidation in Bitcoin dollar. I was watching this range, highest close, lowest close, on the hourly time frame, as I outlined earlier. This was here when price really first came into the range. So you can see on this rally into the level, at the time, I was anticipating the 6150 level here to act as resistance, right? So let's then look at the price action at the level and keep in mind our checklist of, is this aligning with our expectations? Is resistance acting as resistance? If we're expecting this level to force prices lower, are we getting bearish price action at the level, etc., etc.? And you can see here, and by the way, this was a fantastic range to trade because you had like really clear contrast between these two levels in terms of them doing their jobs. So you can see on the underside of the level, you had a close through the level, okay, another close through the level, pullback, found support, you're getting consecutive closes above it, another pullback, you get a nice hammer, close above. So, I mean, if I were to just show you this price action in isolation and just say, here's a line or here's a level, is price here using it as support or resistance? And you would, of course, say support, right? Even at its simplest, not a single hourly close below the level is evidence that the level is being used as support. You even got like a very bearish trap type of setup where you had a spike through the initial high made, and even that wasn't enough to break the level. So this is bullish price action at a level of resistance. So if we're selling here, that's evidence of price not being aligned with what we'd expect, okay? And then the actual trade I took at the level was at 67.01. I think this is on Twitter, where I said weakness below 6,700 and then posted the breakdown. But let's compare those two. Here, first test of the level, closes below it. You get an impulsive push through, close above, okay? Then this candlestick here, I don't have a clear read on that. I don't think it matters too much, but, you know, I'm sure some candlestick expert could come up with a reversal argument for it. And then we pretty much have the opposite of what we had at the lower boundary. We have a close through the level, retest, close below, another close below, and then comes back to the level, close below it once again, and then you get your impulsive engulfing candle through it. Okay, so that's kind of what I mean by price action at a level and using our discretion to make a judgment as to whether the level is performing as it should if our idea is correct. If your idea is that this level at 6150 is resistance, you're not getting any alignment from price because it's actually acting as support very clearly across, you know, half a day, for example. All the closes above it, all the bullish price action, etc., etc. The 67 level is the complete opposite. From a trade management point of view, even if you shorted the breakdown, this first hourly close below it, which was my system's first entry signal here, okay? From a trade management point of view, once we're here with a stop at the high, is there any reason to think that this level is now acting as support or that price action, while we're expecting bearishness, is somehow bullish? Well, no. because it's acting as resistance to all the closes below the level, right? So that's kind of a quick insight into how my system works. I'll have high time frame levels, and then when price comes into them on the hourly time frame, it usually gives me ample time and opportunity to position, and even once positioned, assess and reassess whether I'm on the right side of a structure. Okay? So those examples you could see, sold resistance, price flipped it using a support. Clear example of that at 61.50 weekly level. And I'm sure in the other examples we'll see some of that as well, some of the others. Okay? So that's what I mean by managing both sides of a trade. And just a general trade management example there as well.